This is how Warren Buffett turned $1 into billions. Most people think building billions requires secret knowledge, insider deals, or genius-level IQ. But Warren Buffett's path to wealth is surprisingly simple. So simple, in fact, that it's easy to overlook. He didn't invent new technology or create a viral app. He turned $1 into billions using principles anyone can learn: patience, discipline, compounding, and a deep understanding of value. Buffett's life is a masterclass in long-term investing, not through flashy trades or risky bets, but by consistently applying timeless financial wisdom. In this video, we're breaking down exactly how Warren Buffett built his fortune from a teenager with $1 in his pocket to one of the richest people in history. You'll see the exact habits, strategies, and psychological tools that created his success and how you can apply them to your own financial life no matter where you're starting. He started early and never stopped. Buffett made his first investment at age 11, buying 3 shares of City Service stock for himself and his sister. He earned a small profit, but later regretted selling too soon. That early lesson stuck with him forever. The real rewards come with time. Starting young gave Buffett a massive advantage: time for compounding. The earlier you begin, the more your money can multiply. But more importantly, Buffett didn't just start early. He stayed consistent. While others chased fast money, Buffett built slow money and let it grow uninterrupted for decades. Even if you're starting later in life, the lesson still applies. Start now and stay consistent. The earlier you begin investing and the longer you hold, the larger your wealth grows. Not because you chase returns, but because you give compounding enough time to do its work. Every year you delay reduces your compounding potential. Starting now, even with small amounts, can lead to exponential results decades later. He treated every dollar like a soldier. Buffett once said, "I think of every dollar as an investment. Each one should be working for me." He saw money as a tool, not a toy. While most people see $1 as something to spend, Buffett saw it as something that could earn more dollars and then reinvest those dollars again. This mindset of protecting and multiplying every dollar changed the way he lived. He avoided unnecessary spending, skipped luxury early on, and reinvested almost all his profits. Every time he earned money, he looked for ways to put it back to work. He wasn't just saving, he was building an army of capital. He made sure each dollar was placed where it could grow, even if the returns seemed slow, because long-term growth was the priority. By age 20, Buffett had already saved $10,000. By age 30, he had over $1 million adjusted for inflation. Not through magic, through intense financial discipline and a relentless drive to grow his capital. He mastered the power of compound interest. Buffett's favorite concept in the world of finance is simple: compound interest. Not because it sounds smart, but because it works reliably and exponentially. Compound interest means your money doesn't just grow, it grows on top of itself over and over again. The longer you leave it alone, the faster it multiplies. Here's what most people miss. Buffett didn't make 90% of his wealth until after age 50. Why? Because compound interest needs time, and he gave it decades. That's why he often jokes, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Even a small return, reinvested for a long time, turns tiny dollars into massive wealth. Buffett didn't seek extreme gains. He sought consistent ones. 10% a year for 60 years will outperform nearly any trader chasing 50% gains over 5. It's not about the amount you earn, it's about how long you let your earnings work for you, uninterrupted. He focused on value, not price. Buffett's strategy isn't about buying stocks because they're going up. It's about buying them when they're underpriced compared to their true value. This philosophy, known as value investing, was influenced by his mentor, Benjamin Graham. Buffett learned to analyze companies like businesses, not lottery tickets. He looked at earnings, power management quality, long-term durability, competitive advantages. If a company was worth $1 and selling for 50 cents, Buffett bought it, and he held on to it as long as the fundamentals stayed strong. He famously avoided hot trends and refused to buy into bubbles. While others chased hype, Buffett bought undervalued, stable companies and held them for decades. Coca-Cola, American Express, and Apple are just a few of his long-term plays. Value beats excitement. Consistency beats noise. Buffett's billions came from buying smart, not fast. His goal was to own great businesses at fair prices, not gamble on stocks just because they were trending. He ignored the crowd. Most investors are ruled by emotions. They get excited when markets rise and panic when they fall. Buffett did the opposite. His famous quote says it all: "Be fearful when others are greedy, and greedy when others are fearful." During market crashes, Buffett didn't run. He bought aggressively, often picking up assets at deep discounts. While others were selling in fear, He was hunting for value. That's how he secured massive positions in strong companies during crises. This emotional discipline, resisting panic, ignoring headlines, and sticking to fundamentals, is what separates great investors from average ones. Buffett doesn't trade based on news. He thinks long-term, blocks out noise, and stays rational in irrational times. That mindset made him billions, and it's something every investor can practice. He stayed calm when others panicked, and that calmness allowed him to buy quality companies at bargain prices. He let his investments sit and grow. Buffett's favorite holding period? Forever. He didn't build wealth by buying and selling constantly. He built it by buying good companies and letting them compound over decades, untouched by temporary noise or hype. This strategy, known as buy and hold, avoids costly mistakes like selling too early, missing market rebounds, paying taxes on short-term gains. By staying in the market and letting winners run, Buffett avoided timing mistakes and captured full growth. Apple, for example, became one of his biggest positions, not because he traded it, but because he held it. This also reduced stress. No chasing, no reacting, just owning great businesses and letting time work its magic. He believed that time in the market is more valuable than timing the market, and holding strong businesses is the simplest way to create exponential growth. For the average investor, this is a powerful lesson. You don't need constant action, you need patience. Wealth isn't built from movement, it's built from stillness. He reinvented his strategy, but stayed consistent in principles. Buffett didn't stick to the same exact playbook for 70 years. He adapted his strategy as the world changed, adjusting to new industries, global markets, and evolving business models without abandoning core truths. He started with small stock plays, moved into insurance with Berkshire Hathaway, and later shifted to large public companies. In recent years, he's even embraced tech stocks like Apple and Amazon, something he once avoided. But while the assets evolved, the principles stayed the same. Buy businesses you understand, stick to long-term fundamentals, avoid debt, stay emotionally disciplined, let compounding work. His ability to change tactics without changing core values made his portfolio stronger with time. That flexibility paired with consistency is rare and powerful. He showed that evolving your methods doesn't mean abandoning your foundation. Adapting to change while staying grounded in timeless truths is a hallmark of intelligent investing. It shows that building wealth isn't about being rigid. It's about adapting while staying anchored to proven principles. The blueprint is simpler than you think. Warren Buffett didn't win the game of money through luck, complexity, or timing. He followed a few powerful habits and repeated them over decades. Start early, stay consistent, focus on value, let money compound, avoid emotional mistakes, be patient, disciplined, and boring. These strategies are not exclusive to billionaires. In fact, they work better the earlier and simpler you apply them. So if you're wondering how to build wealth, starting with just $1, follow the Buffett blueprint. Start now, invest wisely, let time be your partner. And remember, it's not about how much you start with, it's about how long you stay in the game. If this video gave you a clearer perspective on building long-term wealth, hit like, drop a comment, and subscribe for more timeless investing insights. Because in a world chasing fast money, the slow and steady win more than anyone realizes.